exchange rate.
Just to follow up to that question, what New Zealand data has been interpreted more strongly than you would?
Well, we've seen over the last couple of weeks unemployment data, retail trade data, which is broadly what we were expecting, broadly what the market was expecting. We've actually seen some slightly more negative data in other countries that have had a rebound effect here, like Australian CPI data. We're not seeing any fundamental change in our understanding of the New Zealand economy out of that data. Some of the markets seem to think there was.
Following the US quantitative easing, do you see a heightened risk of competitive devaluations intensifying the pressures that you already worry about on the New Zealand dollar?
Yes, we think there's an international risk there. That risk has been around for the last few months. The international or the large players are clearly aware of it. They're meeting tomorrow in the G20 leaders meeting in Korea, and I'm sure that will be discussed. There is a risk. We've seen the headlines around US and China currency tensions, but from our point of view, we wouldn't want to see a number of other emerging market economies revert to a more controlled structure. We don't think that would be helpful for the world.
Some other countries are imposing capital controls and taxes on bond investments. Should New Zealand look at something like that?
We note that the countries that are doing that are, first of all, ones that have got limited and not completely open exposure to international markets. Secondly, they are notably doing it at the margin rather than getting in a major way, as happened after the East Asia crisis. So we haven't seen a lot of that happening, and we don't think it's in general applicable to New Zealand policy options.
I note there's some mention there of potential risks, particularly within the rural and farming sector, around mortgages, particularly for those with the higher debt-to-income ratios. How immediate a problem is that perceived by the bank?
Well, we don't think it's an immediate issue because the agricultural prices, and particularly dairy prices, are really quite high at present. But we've seen, as occurred last year, that these prices can be quite volatile, so they can move to high levels and then drop, you know, with the international cycle. So we're aware that some parts of the farming sector and the dairy sector are pretty highly geared and would be vulnerable to sharp movements and those prices, downward movements.
Other than dairy, which other specific sectors within the farming sector would be at risk?
Well, that's a sort of dominant sector that, from a financial stability point of view, that's a thing that would impact the banking system. But obviously there are other sectors that are vulnerable in the agricultural sector, for example, the wine sector at present. But that's not going to have such a big impact on the financial system.
The President of the World Bank has suggested that the global currency system should be realigned and include some perhaps basket of currencies as some sort of reserve, and mentioned the gold price as one way to collect that together. Do you think a return to some sort of gold standard is possible or should be considered?
Bernard, I suggest you read some of the books about the 1920s when the world was in the gold standard and see what a very difficult time that was when you've got an artificial unit of account that can't adjust to price movements, and where you see how some countries manage to manipulate that in a way that looks rather like the currency tensions we're having today. That's a no.
And because some central banks are buying gold, has there ever been a consideration by the Reserve Bank of New Zealand to do that?
Not in the last 30 years, as far as I know.
Could you give us an idea on how the banks are progressing towards the 75% core funding ratio, and whether you're still on track to achieve that for, I think, April next year?
The intent there, it's currently the minimum ratio is 65. The intention is midway through next year to go to 70, and then the following year to 75. Right now, as I said earlier, the banks are comfortably above 65. In fact, they're in the region of sort of 70 to 75. So the banks are already at the sort of levels that we're targeting to achieve over the next couple of years. So in that sense, we certainly intend to increase the minimum level as planned, unless unforeseen circumstances change the shape of the game.
And the issue of capital levels for rural lending, there was a delay until the end of this year. What's the status on that?
We are in discussions with the banks at present. They are modifying their risk models in the rural area, and they need to check those with us to make sure we're happy that the parameters of those models make sense. The net result is that overall risk weights on agricultural lending will increase somewhat compared to what they've been, say, earlier this year. But the banks are recognising that and already changing the models to increase the risk weights. They're recognising that there is significant risk in agricultural lending, and that needs to be better reflected in their models. And we're working towards it, and we should, later this year or early next year, reach agreement on where those risk weights sit.
Because the banks apparently have said that this would increase their costs and that would be passed on to farmers. Is there any estimate of how much that cost might be and whether it should or will be passed on?
Well, when the risk was underweighted, then the huge lending that occurred to the dairy sector in particular back in 2008 was really done on the basis of an underestimation of risk, and the pricing was too thin. So now the banks have already adjusted their pricing on agricultural lending back to more realistic margins that reflect the risk in that business. So I don't think that pricing is going to change going forward from where it has been over the past year or so.
Give an update on what the bank's thinking is on macroprudential policy as a means of regulating the economy, not using the cash rate, and how that might help, whether or not you see it as a tool to take some pressure off the currency.
We're pretty cautious about that. We lay out our views in this report. We've put them on the table. We generally see room for some macro-financial policy to act as an automatic stabiliser, but its scope as a discretionary tool is much less obvious in this. So it's not a silver bullet. So, can't hear.
I mean, are there any ways that you can bring the currency down other than just jawboning it as you've done today?
Well, as we've said, that depends on what's holding the currency up. You need to bear in mind that New Zealand is getting extremely good export commodity prices. These are primarily going into the primary sector. Some of them are being banked. It's not necessarily resulting in money flowing through the high streets. But we are getting very good returns, and that should result in stronger export prices. People who are complaining about export prices are sometimes in different sectors where they're not, but that's the reality. We've only got one currency for New Zealand. If, in addition, that's being bid up by these large international developments, then it's very limited what New Zealand can do. And New Zealand now, as always, has got to do the best it can in a difficult world in a realistic sort of way. If there's some misinterpretation of New Zealand data, as we feel there might have been over the last couple of weeks, then we'll look for the market to correct that, and we'll be talking further about that when we put out the monetary policy statement in a month's time. Any more questions, ladies and gentlemen?
Are you concerned in the long term that central banks elsewhere doing bigger than neighbour sort of competitive devaluations will mean that New Zealand doesn't rebalance its economy. And is there anything you can do about that?
Well, Bernard, you will know the old Swahili quote about when elephants make love and make war, the grass gets crushed. And that is a risk for smaller economies in a situation like that. Perhaps luckily there's more discussion at the G20 level now, which does include a number of countries that have got our sort of interests at heart, other commodity exporters, emerging markets and so on. Yes, there's risk for the world in that, but it's not in the interest of the major economies either to do unilateral things which lead to other more broad problems, and I think that's come home to them pretty clearly over the last few months.
Just following on that, what would you like to see come out of the G20? What would constitute a good outcome from your point of view?
We'd like to see an understanding on both sides of the Pacific and indeed the Atlantic that it's very important that exchange rates reflect sustainable long-term real economic competitiveness and real economic prices to give the right sort of signal, and that they're able to give enough confidence to the markets that that sort of position can be reached in a reasonable time.
Just finally, there's been a lot of debate across the Tasman about Australian bank profits and whether they're colluding on pricing. Are you concerned about the level of profits or how the banks, those same banks here, are operating?
No, I think the situation here is quite different because credit demand has been so weak in New Zealand over this period, and that's in contrast to what's been happening in Australia. So bank balance sheets are very static at the moment, and I think you'll see that reflected through in returns generally. Well, thank you, ladies and gentlemen. If there's no more questions, thank you. That's the end of this press conference.